Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year no yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 19...
Waiting to see how low the Dow will go. They're focused on the Dow.
The S&P struggles near a critical 6,000 level. Certain stocks and sectors are breaking out, while others face major shifts. Jerome Powell speaks, but the bond market keeps selling off. Now, let's dive into the big story. The S&P futures, ES, are holding above 6,053.25, a level not mirrored by the NASDAQ. This dates back to July 11th, when CPI data showed a rare month-over-month decline, marking a key moment tied to recession fears. What we're seeing is a tale of two tapes, with ES showing resilience. Keeping these levels on our charts will be crucial as we navigate the markets ahead. Hello, everyone. Welcome to the weekend edition of Markets Around the World. I'm K2, and today we'll cover the latest market updates, key macroeconomic trends, and critical levels to watch. If you're passionate about the markets, don't forget to subscribe and stay ahead of the game. Let's dive in and break it all down. The U.S. stock market's post-election rally hit a snag, likely overdue for a pullback, after surging following Donald Trump's November 5 presidential win. The catalyst? Federal Reserve Chair Jerome Powell's remarks on Thursday in Dallas. Powell reiterated the Fed wasn't rushing to cut rates further, echoing his November 7 comments after a 25 basis point cut. This raised concerns about the pace of future cuts in market rates, overshadowing Trump's economic plans. Stocks extended losses, with the Dow down 1.3%, the S&P 500 falling 2.2%, and the NASDAQ dropping 3.3% for the week. The small-cap Russell 2000, a Trump trade favorite, tumbled over 4%. U.S. large-cap stocks are at their most expensive levels since 2021, based on metrics like the CAPE ratio and forward price to sales. While high valuations often signal caution, strategists warn that expensive stocks can still climb higher. Investors may find better value in small and mid-caps, or underperforming sectors like healthcare and real estate. NVIDIA's upcoming earnings report is poised to influence the U.S. stock market's direction, especially as investor attention shifts to the technology sector and artificial intelligence following a post-election rally. Over the past 2 years, NVIDIA's stock has surged nearly 800%, propelled by its leading position in the AI industry, elevating the company to the top spot by market value. The semiconductor industry could face challenges under President-elect Donald Trump. Proposed 60% tariffs on Chinese imports may drive up electronics prices, while Trump's criticism of the CHIPS Act raises concerns about U.S. chip production incentives. Export restrictions on advanced chip-making equipment to China could further impact U.S. manufacturers, disrupting the global supply chain. Now let's expand the conversation to analyze some data, starting with the equity risk premium, comparing the S&P 500's expected earnings yield to the 10-year Treasury yield, has fallen to its lowest level since 2002. With elevated Treasury returns, stocks may offer less compelling risk-adjusted returns, prompting investors to reconsider equities versus bonds. The 30-year Treasury yield has risen approximately 60 basis points in 2 months, surpassing the Fed funds rate for the first time since Q4 2022, as the Fed cut rates from 5.50% to 4.75%. Historically, a positive yield curve after inversion has signaled a recession within months. However, a soft landing could break this trend, leaving the outcome uncertain. Money market fund assets have hit a record $7 trillion, with $91 billion added last week, despite a 25 basis point Fed rate cut. These assets have doubled in 4.5 years, and the Crane 100 Money Fund Index reports an average yield of 4.51%, reflecting strong investor demand for safety and attractive returns. The Federal Reserve aims to prevent stagflation, a scenario of rising unemployment coupled with high inflation, reminiscent of the 1970s. As of October 2024, the U.S. unemployment rate stands at 4.1%, with inflation at 2.6%. These figures suggest that while both metrics have increased slightly, the economy has not entered stagflation. The Fed continues to monitor these indicators closely to maintain economic stability. The iShares Bitcoin Trust, IBIT, set a record by reaching $40 billion in AUM in just 211 days, far outpacing the previous fastest ETF, which took 1,253 days. This milestone highlights growing institutional interest and the rising mainstream acceptance of Bitcoin. Now let's take a look at the S&P 500 heat map. Microsoft dropped 1.78%. Nvidia fell 3.83%. Amazon and Alphabet both declined by 3%. Tesla and Apple remained flat for the week. Meta had the largest drop, down 6%. In terms of sectors, healthcare was the worst performer, while the financial sector led as the best-performing sector of the week. The Fear and Greed Index is back at a neutral 51, reflecting balanced market sentiment. Whether it shifts to extreme fear next week depends on factors like economic data, corporate earnings, and geopolitical events. Share your thoughts in the comments. All right, we're approaching one of the most anticipated events in the market, Nvidia's earnings release after hours on Wednesday. This is a key event for the market and could have a significant impact. The companies marked with red boxes are ones I like to trade around earnings. If you're interested, be sure to take a screenshot or pause the video to review them. Remember, trading during earnings season can be volatile, so do your research and manage your risk carefully. Let's analyze the SPY 4-hour chart. Bearish scenario. If the price falls below $585 and breaks the trend line, it would indicate a bearish signal, potentially leading to further market declines. Bullish scenario. If the price bounces from this level, we could see new highs this week, especially following strong earnings from Nvidia. With Nvidia's earnings set to release after hours on Wednesday, November 20th, 2024, its performance could significantly influence market sentiment and SPY's movement. Keep a close eye on these key levels and be prepared for potential volatility. Let's see the QQQ 4-hour chart. Bearish scenario. If the price breaks below the trend line, we could see a pullback to the 484 level. Bullish scenario. If the price rises above $503, it's a bullish signal, and we might see a gap fill and potentially new highs. Next chart, the iShares. Russell 2000 ETF IWM, on the weekly chart, reveals a pattern where IWM has historically peaked around November 21st. Currently, IWM is approaching similar levels this November. If it fails to surpass its previous high, this could be a cause for concern, potentially leading to increased volatility in the coming week. Monitoring IWM's performance closely will be crucial to anticipate its next movements. This week's economic calendar is relatively light, with existing home sales data being the primary event that could introduce market volatility. Other scheduled releases are not expected to significantly impact market movements. However, Nvidia's earnings report, set for release after market close on Wednesday, November 20th, 2024, is highly anticipated. Given Nvidia's substantial influence in the technology sector, its performance could have a notable effect on market sentiment. All right, ladies and gentlemen, that's all for this video. If you found value in this content, please like and subscribe. If you have any questions, drop them in the comments below, and I'll get back to you as soon as I can. Thanks for watching, and I'll see you next time. Bye for now.